My name is David Glasscock. I'm president of NADCAR this year, and I want to welcome you here. We've got a great program, and first of all, we couldn't have this program if we didn't have our sponsors, and I'd like to review who our sponsors are this year. Our gold sponsors are Bradford, CBRE, Intos Designs, Granite, Henry S. Miller, Highland Builders, The Colony, Retail Connection, Mr. Shore, thank you very much, Transwestern. Silver sponsors, Colliers International, Steve, thank you, Crestview, Duke, Lee, Paladin, Parmenter Realty, Peloton, Weitzman, Xceligent, Younger Partners, Moody, thank you, Hudson Peters, and OFS Brands. And our media sponsor, of course, is the Dallas Morning News. So thank you, sponsors. We couldn't be here without you. We've got a great program today, but right before we start, I want to tell you about a couple of little things that we have coming up in the marketplace for NADCAR that are pretty good for either you and your associates. We have a commercial lease program. It's called What You Don't Know About Commercial Leasing. And Stuart Lawton, who's an attorney who I've seen do this before, along with Peter Graff, who's the general counsel over at Republic Title. This is a NADCAR members-only program, and space is limited, and it'll be September 29th, so look on the website. But it's really great because they kind of play off back and forth between leases, and they're going to use the new NADCAR lease form, and it's great for their young associates that possibly don't, just entering the business, or seasoned veterans. Also the 29th, the young professionals who are a part of our organization have an up-close and personal with my good friend Jeff Schwope and Steve Midori, the Champion Partners. And usually this is a small venue setting. It's for NADCAR members only, and space is limited there, so it's always neat to have an opportunity to talk to developers that have been successful in the marketplace. On the 7th, a great industrial tour at Alliance in North Fort Worth. Tony Cream's on our board. He's put together an outstanding, along with the others, to put down an outstanding tour. Lunch is going to be at Hillwood Circle T Ranch in Westlake, and they're going to be doing some drawings for helicopter tours, and to a few lucky brokers. So hopefully Ross will allow his helicopter to be flown in and around. It'll be fun. It should be a great weekend. On the 21st, we're going to go up to Legacy for the Upper Tollway. A lot of activity up in north in Legacy and Upper Tollway, Planos. So that'll be the 21st. So also we have, let's see, we're going to have we have an online CE program that we're partnering with a CE shop, and this is an online commercial continuing education program. So the next time you need CE, go online to our website. It's really more oriented to commercial than some of the ones that you see online that you have to do real quick, that you have to go through a lot of the residential pieces. So we've tried to organize this where it's real effective and you can spend some time reviewing some of the commercial topics that are a little bit more relevant. We're going to be recording this program today, and with that said, I want to introduce our moderator today, Pam Goodwin. Pam is founder and owner of the Goodwin Commercial. That's a boutique commercial company here, and a consulting firm specializing in retail and restaurant pad sites. This is kind of interesting. Pam has written and published 2 books. The 1 Cent Lemonade to $1 Million Deals, 25 Jobs and Lessons. Wish I Learned Sooner. And this is the #1 bestseller on Amazon, so you guys can just hook it up right now and pick that up. I wish Pam had a bunch of books up here for sale. We would do that, but
right, I need to sell books.
Sell books, absolutely. Also, Winning Ways in Commercial Real Estate. 18 successful women unveil the tips and trades in the commercial real estate world. She's creator of a 4-part audio real estate program, How to Win in Commercial Real Estate, 0 to $1 million with 1 deal. So with that said, I want to turn it over to Pam and welcome. Great program coming.
Thanks, David. I appreciate that. I had to write some books and create an audio class in between brokerage and development deals, so a little passive income. But thank you so much for being here today. They say that 80% of success is just showing up, so give yourself a hand for waking up early this morning. That's great. So today, as you can see up here, we have 3 of the top heavy hitters and power brokers in Dallas in each one of their categories: office, retail, and industrial. And doing a little bit of research, 2015, there was more than $533 billion in commercial real estate sales. And I think these 3 had a big part of it, since Dallas was number 4 with $20 billion in sales. So it's been a great year for Texas. So we're going to spend about the next 45 minutes with these 3 experts really going over what's happening in the market, investment sales, their secrets to success, if you want to become an investment broker, what you need to do. So we'll get started. We're going to start with our first, Dustin Volz. He's the Senior VP Capital Markets in the Industrial Investment Sales, joining the firm in January of 2016. And prior to that, Dustin was in the investment division at Younger Partners. And so with more than 9 years of real estate investment sales, he has closed more than 500 million commercial transactions. And he is a graduate of the University of Kansas, a Jayhawk. Welcome, Dustin.
Thanks, Pam.
I'm a Nebraska Cornhusker, so I remember playing those Jayhawks a while back. Now we have Jennifer Pearson. With more than 25-year career, Jennifer has marketed and sold hundreds of retail properties, totaling more than $3 billion, that's with a B, in sales. Jennifer was the top producer at CBRE for virtually every year of her 21-year career with them. That's a long time.
I was among.
And Jennifer started Pearson Retail Advisors in March of 2015, and she's a graduate of Arizona State. And asking her favorite book is Rich Dad, Poor Dad by Robert Kiyosaki. And also, she's a #1 best-selling author in Our Winning Ways. So if you want to pick up that book, her chapter is definitely worth reading on her success. And the #1 thing I learned was, which I am supposed to do, is time blocking. But Jennifer is time blocking. So if you want to meet with her, you better get in her time block. Right, Jennifer? Welcome.
Thank you, Pam.
We have Creighton Stark. He's the Executive VP of Capital Markets Group with Colliers International. And with more than 17 years of experience, Creighton specializes in investment sales of office assets and solely transacted over 4 million square feet of office space within the last 24 months, with more than $300 million in sales. And one thing you might not know about Creighton is that he won the state title in swimming every year he was in high school. So he's the Michael Phelps, right? You were the Michael Phelps?
Not hardly.
And he was on a full scholarship athlete in swimming for the University of Louisville Cardinals before transferring and graduating from Tulane in New Orleans. And his favorite book, besides Winning Ways, is Success is a Choice by Rick Pitino. Welcome, Creighton.
Thank you very much, Pam.
So we know investment sales these days in Texas. I mean, Texas has been a really, really strong market and really, really hot. So if each one of you could just take a few minutes to give a big picture to everyone to see, is it a tight investment market? Are things closing quickly? Where are you finding your inventory for your buyers, location? If we could just start with Dustin.
Yep. So, when I look at the market, it's definitely a very tight market, and I think the market continues to improve. There's two big drivers I look at in the investment sales world. I think it all starts with tenant demand. We had a record year last year with 18 million square feet absorbed on the industrial side. I think we're on pace to probably break that this year, probably close to 20 million square feet. We did just over 10 through the first half of this year. So with that, and then also the availability of capital, I think it's going to lead to more good things to come, and I still think we're pretty early in the cycle. I may be a little contrarian, but I get paid to be optimistic. So I think Dallas has a good long runway left over the next 3 to 4 years, and primarily looking just at tenant demand. Because you look at 17, we have a ton of deals that are out in the market. There's about 23 million square feet of industrial deals that are over 150,000 square feet that we're tracking in the Dallas market. That'll lead us through 17 and through at least third quarter of 18 with those deals getting absorbed and coming to the market.
Next. Yes, Jennifer, go ahead. What are you seeing out there in the big picture of what's been going on for the last year with investments?
It's definitely tight, as we all know. That's a little bit redundant. But as far as volume and velocity of trades, a tight market doesn't necessarily mean that there's not product out there to buy. So for retail, which is what I sell, we're at the highest occupancy levels since I've been in the business, and we're at very high rental rates. But we're still, every year since 2011, we're trading more retail properties. So last year, 2015, we sold 647 multi-tenant retail deals. And this year, this is all per CoStar, this year at the turn of the year, we were at 371. So, and typically December is a high volume month, so we're on pace to beat that number. And we continue to have more and more trades every year as we progress. The difference is, you hear when you're visiting, you probably heard in the networking that it's really hard to find product. It's just hard to find good product because we're all very used to, we saw when the financial crisis hit and people were picking up deals at a 10 cap at 50% occupancy based on existing, and you can't find those anymore. So it's not that you can't find deals to buy, you certainly can, but you can't find, the great deals where you're going to hit it out of the park. And I think as far as prognosticating on the future of where we're going, everyone says we're long in the tooth in this cycle, and I think we probably are comparatively, but I can't figure out what's going to slow us down. Everything looks to me like it's progressing, and now if you look at us compared to gateway markets, we're a pretty good value. I'm looking at all these familiar faces, and I'm saying these things, and I'm thinking to myself, everybody already knows this. I'll try to come up with something a little more enlightening, but so I don't really see us slowing down either, unless something comes out of left field like China or something like that.
Jennifer, I know in the retail, are you seeing more people buy in the large markets, the DFW, Houston, San Antonio, or smaller markets, East Texas, West Texas, South Texas? Where are you seeing your retail centers?
Well, it's a good question. It depends on your acquisition criteria. So some people, their entire model is based on buying core real estate that's for, say, a generational fund. So they're buying in core product, in core markets. You can pick up, you used to be able to pick up 50 to 100 basis points by going in tertiary markets, but even that's getting tighter. So from a brokerage standpoint, we go all over Texas, and we go to the deal. Somebody says, we want you to sell this, we say, okay, we'll go to Midland, we'll go wherever it is. But they're trading all over. They're trading inside DFW, and they're trading in tertiary markets as well.
Right. In Creighton, on the office side, what are you seeing out there as far as what investors are looking for, primarily the location, value-add properties? What is happening in the office investment world?
Well, I believe that every deal is specific to, obviously, location and to the product. Every deal has a different story, and obviously the deals in Uptown are trading a little bit differently than the deals in Arlington. That being said, I kind of feel like Uptown still has a lot of legs left in it. If you look comparatively We did a study recently, The Tale of Two Cities, between Austin and DFW. We are basically where Austin was 2 years ago. So where they were trading at $500 a foot, we were trading at $3. Today they're trading at $7, we're trading at $5. So if you believe that story and you believe that eventually we'll catch up with Austin, I think you're in a great position to be buying a property at $500 a foot today in Uptown. Of course, like Dustin said, I get paid to be optimistic. On the other hand, if your property's not in the middle of the fairway and it's in Arlington or out by the airport, Freeport area, there's still an audience for that property. It's being able to pick out who that specific group is based on what criteria they have, as well as what the property has to offer. For example, we have a listing in Tyler, downtown Tyler, Texas. It's got its own attributes. The building's never dipped below 87% occupancy since its inception in 1979. So we call that the exception to the recession. There's a different buyer for every type of product and every type of market. It's being able to distinguish between who those groups are and who they are. The last thing you want to do for your client is get into a position where whoever the buyer is not able or capable of closing because of reasons that were not obvious in the first place.
Great, thank you.
Can I tag on to that, Pam? The Tale of Two Cities dialogue is really a very interesting one. I haven't heard anybody compare Austin to Dallas, but I hear in the retail sector a lot of people say, are we the new Los Angeles? So after I heard that 4 or 5 times, I started digging into what did the numbers look like in Los Angeles, because the comparison is from 1985 to today, the growth in Los Angeles, and now they're actually contracting because they have their business environment is a little more hostile than ours, so everyone is migrating from California to here. But from 1985, for the next 20 years, the city of Los Angeles grew by 2.4 million people. Dallas-Fort Worth, today we've got 7 million people. Over the next 15 years, we're scheduled to grow by 4 million people. So we could easily bypass the story of Los Angeles if that growth actually takes hold. So it's a very interesting comparison to try to project the future.
Well, and one thing I didn't touch on is similarly, you've got to look at the dynamics of both cities and where they were at the time. If you look at the rental rate growth over the past couple of years, we're tracking Austin very closely. And I'm talking about uptown Dallas, specifically to downtown Austin. The other dynamic is we have about the same amount of square footage online. We have pretty much the same barriers to entry and the same cost of new development. So if you take all of those factors into play, as well as job growth, you'll see that they're really closely related.
That's great. So what is it right now like for your sellers? I know, we develop property, and we recently sold 2 single-tenant net lease deals in Tyler, Texas, which we weren't planning on selling, but it seems like a seller's market. And I know some of you may have read, but Hugh Hefner sold the Playboy Mansion this summer for $100 million. And he bought it in 1971 for $1.1 million. So it's definitely a seller's market for him. He gets to lease it, I think they said, until he dies, and he's 90 if anybody cares. But so as a seller, where do your sellers take the cash? Are they 1031 exchange deals? Are they realistic with their cap rates? Some of them are so low these days. So if you could just answer a few of those questions.
Well, yeah, I think the sellers fall in a couple different categories. So you obviously have your fee developers who get paid to build buildings and they roll them out. They take advantage of the credit of the tenant. The other guys we're seeing that are very active in the market are your GPs that have went into value-add properties, converted on their plan, and then they're rolling out of it to make their money on the outside of the deal. A lot of those guys are cashing out of the deals, kind of waiting on the sideline, being a little bit more patient with what they're doing. a lot of your bigger guys that are selling deals right now are pruning a lot of their portfolio and continue to go after more core assets?
We track straight trades as well as 1031 exchanges. We're most definitely seeing the 1031 exchange environment heat up. I heard one guy who's a really smart shopping center investor say he doesn't ever do a 1031 exchange because he believes for certain that the tax rates are going to increase as life goes on, and he doesn't want to get caught into a very low basis and a huge tax nut for him or for his kids, so he doesn't exchange ever, which I found to be a fascinating concept. But most people are doing more and more exchanges. For the last couple of years, most of our buyers, we also track where everyone is coming from that we transact with. So most of our buyers have actually been in Texas, which is very different from the 2005, 6, 7 market. But now we're starting to see a lot more gateway owners come into Texas again, a lot of California. In 2007, 60% of our buyer pool was California money. It's not near that high, but it's creeping up. And we're also seeing a lot of Florida, a lot of New York buyers. To answer your question, Pam, it's a great time to sell for the brokers out there. If an owner is sort of in another business model and not really paying attention to what's happening, that's a very easy way to get them to look seriously at transacting and selling their property, because chances are they're probably picking up a couple hundred basis points selling now than when they bought it. So it's a seller's market. I hear a lot, I can't buy from you because everything that you sell is marketed too widely, which is kind of the truth. But if you want to sell, if you're selling office or retail or industrial and you want to get your product out there and maximize value, it's a good idea to get somebody who can spatter it all over the world and compress your cap rate. So we're seeing a lot of that. A lot of people are taking advantage of that.
I think there's two thoughts to what you do with your money if you're going into a 1031 or coming out of one. One is, where are we in the cycle? And there's a couple of different thoughts there. Some groups are saying we're in the 7th inning of a doubleheader. Others are saying it's a tie ball game and it could end at any minute with some worldwide catastrophe. If you believe either one of those thoughts, I mean, the bottom line is that a lot of groups are saying, we don't care if we 1031 or not. We'd rather take the proceeds, stock it away, and have some dry powder for when this thing comes to a halt. Other groups are taking their 1031, and either they're 1031ing out of a B property into an A or an A into a double A, and they're not necessarily so concerned with where we are in the cycle because they're solving for a 10, 15, 20-year IRR. And in that case, it's really about just upgrading their product type and protecting their wealth. So, it's kind of it's going both ways for us with different types of investors depending on what their business plan is.
Creighton, how do you qualify your buyers, to make sure, and especially if you're getting multiple offers, qualifying them that they can actually, close on the property? If you could just go over that, and or if any deals are falling out and why, what you're seeing?
It's really difficult to ultimately qualify a buyer. You can't obviously 100% qualify them. Reasons for that is, a lot of times you just have to take a leap of faith. It depends on where we are in pricing and what the terms are. One of the big things that we like to do is get some non-refundable earnest money sooner than later, which usually gives some level of commitment that you wouldn't otherwise have. Other than that, it doesn't matter if they've got the proceeds locked away in an account that you can actually see or not. You also have to go on reputation. And if they have a history of retrading or of dropping contracts, that certainly sends up some flags. So, it's a tough process, but we definitely are always learning, or there's always different situations, and we're always trying to make sure that we do the best we can for our clients.
Good. Jennifer, are you seeing any, fallout of your retail properties once they put it under contract, or are they buying
sure.
and closing in 30 days?
I wish I could say they all close in 30 days, but certainly we do see fallout. We go through a pretty rigorous interview process when we pick a buyer. We have about a 15-question questionnaire, and we ask them everything from, is there room in your price? Have you looked at the roof? Have you walked the property? Have you had anything under contract in the last 12 months that you've dropped? Why did you drop it? What could kill this deal? I mean, we go through a pretty rigorous digging into who they are and what they do. And just like Creighton said, it is probably one of the hardest things that we do because you really can't control. But we do get references, and we call and we find out what their history is. We don't like to go under contract with somebody who retrades for sport, and we try to get, which I think might be a little bit unique, we try to get all the warts of the property off the table from the onset. So if we know there's a bad roof, when they're in a best and final round and they're bidding against each other, we say, we need something in writing that says that you've taken the roof off the table, and now what's your bid? And then they really can't come back and say, okay, we need a $300,000 retrade because of the roof. So we've spent a lot of time trying to perfect that process because it's either a path to success or a path to failure, so it's important.
Mm-hmm.
Yeah, I think one other key piece is just looking at their debt equity. Do they have their equity raised already? What is their track record of going out and raising it if they don't have it raised already? And then also understanding how they're underwriting the asset, because, the CMBS market had a lot of volatility earlier this year that caused some deals to get a little shaky, so it's understanding what their plans are on that side of it. Obviously, on the industrial world, we're a little bit more insulated with life company debt, but it's just seeing how much the markets are moving and how that's going to affect their underwriting and what it'll do to their pricing long term.
Great. Well, I know all three of you have been in commercial real estate for more than 10 years. And I'm sure a lot of us would like to hear your strategies and secrets and how much you make in commission every year. No, I'm just kidding. How about some, war stories? You've been in it for, Jennifer, coming from a large company and now having your own company versus Colliers and JLL, some of the largest firms in the world. Just sharing some ideas of, any of your success stories you can share.
Well, if anyone's looking at starting their own company, please reach out to me because I can help. I would say the first month maybe that we really just picked up our team and started this company. So it wasn't a big deal. It was sort of like stepping off the curb. It was kind of the same thing, but same client, same everything, except for getting the office set up. I was close to being in a fetal position with the copier and the printer and the computers and the IT guy, and that was one that I didn't see coming. So, but once we got past that point, it was fine, and it's a lot of fun. War stories of being in the market. I'm the oldest one up here. So back when I started, I'm looking out into the audience, and there's a lot of women out in the audience, a lot more than there were 20 years ago. So, I heard especially at the beginning, I heard girl, why don't you'd be good at selling houses. Why don't you go sell houses? That'd be good. And you just, that happened to be a guy at TV, and I just smiled and I thought to myself, my numbers are going to be higher than yours every year going forward. That's how this is going to go. And so you see a little bit of that, but I think also being a woman is a huge advantage. So you can get into doors faster. You just better know what you're talking about when you get in, and they'll remember you. But, you know, for the most part, it's, for anybody who's just getting started, I think it's the best business in the world, and you can take it as far as you want to take it. And to get in a point in your career where I've been doing this for almost 25 years, you know, you get to come to events like this, and there's so many familiar faces, familiar friends. It's terrific to keep doing this for as long as I've been doing it. So advice to somebody who's just getting going, I would say pick something and stick to it and be known for it, because you're trying to create that kind of traction, and then hopefully you get to a point where if somebody's going to sell a shopping center, they'll at least let you throw your hat in the ring and you can be part of the bidding process, and then, you know, it becomes a little bit more automated than it was at the beginning. But I also think that there's no substitute for hard work. There really isn't. It's not a 9-to-5 job, as I know virtually all of you know. It's long hours and it's hard work. So if you love it and your heart is in it, then it becomes fun and not work, and then all those long hours are enjoyable. But I haven't figured out how to shortcut it. I haven't figured out how to dabble in it and make a lot of money and be successful. I just don't think it works that way, and I haven't seen anybody else do that either.
Can you share, Jennifer, quickly maybe what one of, in the 25 years, your best deal that comes to mind, your best deal or favorite deal, and why?
Oh, God. Well, my model is volume and velocity. We sell a lot of deals. I can tell you that now, I don't know if this is my best attribute, but I'm now getting to the point in my career where I'm selling things for the third time, which is a little fun and a little unnerving all at once.
Thanks. How about Justin? How about you? Do you want to?
Yeah, I mean, I think the biggest thing for me when I first got in the business was understanding that you needed to be knowledgeable in all aspects of the business. So there's portfolio managers, there's asset managers, there's property management guys, then there's the agency, the tenant rep guys, all sides of the business, and understanding how they all work together, and how you, and really going out and finding pretty much a mentor in each side of that business. So if you got a question, find a good lawyer, find a good accountant, find somebody that you can call to ask those questions on that you may know a little bit about, but you need to know more about. That was the biggest thing that I learned, and that makes your life so much easier when you can go out and call somebody that's an expert versus trying to figure it out by yourself.
Have a favorite deal you've worked on? How is it with JLL working for a large company?
Well, I'm going to tell a different story. So the first investment deal I ever sold was at Marcus and Millichap. I was an office and industrial guy, and we were sitting in a Monday morning meeting, and I talked to a client that Friday, and he said, hey, we're 1031, we're selling an office building down in Houston, we want to buy a retail deal in Dallas, we need to close by the end of the year. And
why didn't you call me?
well, Marcus had one listed, so I made the call on Monday, had it under contract by Wednesday, and it closed 22 days later. So that was my easiest deal I've ever done, the first one I've ever done, and I haven't been that lucky since.
No, yeah. And Creighton, being a power broker and heavy hitter nominated year after year after year, congratulations on it. I know that's hard. How about some of your war stories and success, and maybe your best deal that you remember?
Well, those of you who know me out there know that I do a lot of off-market transactions. I'm actually pretty good at it. And it's something that I learned early on at John Bowles Company, and that was, they always told me, work smarter, not harder. This is when I first got in the business. And I thought, you know, I've got that working harder thing down. I can do that, but what if I could do both? And so that's what an off-market deal is figuring out what exactly it is that your buyer looks for returns, what their needs are, their demands, and then what a seller would be willing to part ways from the property with. You know, that's a very rich juggling act, and it's very rewarding. It's a lot of fun. And those are the types of deals that are probably my biggest success stories. They do take a lot more effort. They take a lot more thought, a lot more creativity. You only have one buyer. There's always a chance, a strong likelihood for a retrade, because there's not another group hanging around that you can go to if things start to go sideways. And like Jennifer just said, probably one of the most rewarding things in our business is being able to sell a property for a client 3 times. And so when we sell a property to a client, specifically off market, and we get to see their success for having rolled the dice and taken that chance and purchased the property and turned it around and made it into a little jewel, having the opportunity to share on the other side as the selling broker and sharing in that success. That's probably the most rewarding thing. And one of my first stories was back in 2007. I had my own company at the time, and I had found a property online. I forget the name of the site, but it was a single-tenant property, $20 million, and this was 2007, and we bought the property at a 9 cap with a credit tenant. I went to the seller afterward and said, "You just got this for a 9. Do you realize that properties in the market are trading at 7s right now?" He said, "Yes." I said, "Let me list this. Let's go to the market and let's try and do better." Literally 6 months later, we sold the property for $24 million, and that was huge. I was elated, and it was bigger than the fee. It was just knowing that I really did my job well for the client.
That's great. So what would you advise if any of the people in this room, I know several of them invest in their own property, but what are the top 3 things to look for besides price and cap rate to find an investment property? Do you want to start?
Yeah, I think the one thing I would look for right now is I would fly to quality of the deal. I wouldn't try and chase the bigger returns. I think we're in a lower return environment right now. I think that'll be the new norm for a while. You can still get really nice returns if you can, put the right kind of debt on assets, but don't go out there and try and chase 10, 11% unlevered returns on really tough deals in today's market, because especially your first deal, because those are the guys that have a hard time. Go after something that's got some cash flow in place and make it a little bit easier on yourself.
That question is actually, as it relates to retail, a little different. So we're in a unique environment right now for retail, where retailers are trying to right-size their footprint with their bricks-and-mortar presence versus their online presence. So we have a lot of buyers whose model, their buying criteria model, action type of retailers, because they want to make sure that the tenancy that they're buying is sustainable as people start going to more of an online presence. So nail salons, people want to be, is becoming more and more important on the retail sector.
So, I don't understand. What was the...
Just if you were to advise someone on buying an investment property, what are the 3 key things people look for? Price, cap rate, location.
Yeah, so definitely location is number 1. This is still real estate, so at the end of the day, it's all about where you are, and that kind of plays into how you're going to see the property through on appreciation. I'd say the second most important thing is the tenant credits, or the credit of the tenancy. You want to know that they're going to be able to weather the storm with you through ownership. At the end of the day, it's partnership between the tenant and the ownership, and getting through a lot of different ups and downs. And I guess lastly would be the term, knowing that you have a commitment from the tenants. And obviously that's where your true value comes from, and that's how we're able to finance properties as well.
Are you, with your sellers, regarding your commission, are you having, sellers think they can sell their property on their own? Are you seeing anything where the sellers are, wanting to lower commission or refusing or making your buyer pay the commission? Are you seeing that going on?
Those conversations happen in every market.
With every broker, right? The people that we work with, the men and women who own these shopping centers, they're smart people, and they're trying to get the best value they can out of their property for the least amount of cost. But I also heard very early on at CB, and I think it's true, that if you hire monkeys, or if you pay peanuts, you get monkeys. So, there's value in what we do. We've all been doing this for a very long time, and we have systems in place, and we have reach to buyers, and we know how to negotiate the deal and push value. So, I think as you get older, it doesn't happen quite that much. One thing that I have seen throughout my career, which this could be informative, is sometimes people will say, I want to sell this shopping center and I want to list it with you, but I have 2 buyers that I know could buy it, and I want to exclude them from the listing agreement. So we have a very hard and fast rule that we don't do any exclusions, because if you think about it, it doesn't make sense to go down the road with a seller when you're not really partners and they could sell it out from under you. So you're giving it all you've got, and then they've got kind of an out. So what we say is, go talk to those guys, see if you can sell it to them first, or gals, and then come back, and then let's make this arrangement a formal, aligned partnership, and then go down the road together and see if we can transact.
I think one piece to add on to that is you can get a little bit more creative too as well. On that side of it, if they're willing to offer $20 million for the property, you can come up as a broker with some sort of incentive structure on the back end. If you're excluding those 2 people, if you get them and they end up being the ultimate buyer and they come up from their $20 million number, you can get compensated that way as well too.
I agree. That's exactly what I was going to touch on. Is we'll a lot of times do a kicker if we hit a certain price point and then above. So, where it might be a half a point up to, call it $30 million. If we hit above that, it's another 3%.
That's good. Well, in concluding, if you had a crystal ball, and now that 2017 is coming up, and 10 years almost from the crash, what do you see, or what are you predicting out there as far as what's happening in office, industrial, in retail? I know I specialize in retail and restaurant development, and so thank goodness you can't eat online, so it's still really good for the restaurant business. But if you could just go kind of if you were to predict what's happening for 2017, will it be as strong?
Yeah, I think it'll be just as strong. Obviously, 16 was a year of a lot of entity-level transactions, so billion-dollar-plus transactions that happened. So I think you're going to see less of that this year, and we have seen it already. And what you're starting to see is more institutional capital starting to chase more onesies, twosies, smaller deals, because that's the only way they can get capital out right now. And as far as what I see long term, I think Dallas is poised for a good long growth cycle. I think our next pullback is going to be a very soft pullback. There's so much institutional and international capital that was investing with partners now that's out on its own now looking for deals. They're late to the Dallas market. So once we do have a little bit of a pullback, I think they're going to be very quick to jump in and help bolster our pricing up. We've seen a fundamental shift on what the norm is from a cap rate range and a price per pound range in Dallas, and I think that's kind of here to stay long term.
I am not an economist, and I don't know, and this is being filmed. So, but I could say that it feels very different than it did in 2006 and 2007. Just if you look at the CMBS originations, we did over $200 billion in CMBS loan originations in 2007 alone. And this year, at the mid-year point, we're only at $30 billion. So the debt is not crazy. It doesn't feel as insane as it did in 2007. But to Dustin's point, we're more optimistic than not. I mean, I remember in 2007 thinking to myself, this is going to end soon. I can feel it. This is going to crash. But it doesn't feel that way now. And we're hiring brokers, so as I realize I'm looking at an audience possibly half brokers, we're hiring an office investment sale broker, or looking to an industrial investment sale broker, a net lease investment sale broker. So we're beefing up because we think the ride's going to be longer rather than shorter.
I believe 17 will still be as strong, maybe slightly short of 16. My reasoning for that is just purely based on job growth. There were, 170,000 jobs created in Texas last year, and 110,000 of them were in Dallas. Usually that's a trickle down, so if that was, for the last year, usually the next 2 years is pretty strong as far as ancillary companies coming in. All of that being said, I think the dynamics are strong. As far as the development cycle goes, we typically are not building spec. Typically the space is already spoken for. I think of the 5.7 million square feet that have been developed over the past 12 months, 60% of it was pre-leased. So I could be off a little bit there one way or another, but end of the day, I think that the overall fundamentals of Dallas are different than they were, call it 10 years ago, in 2007, and I just think that it's going to be a little bit slower of a fallout, if at all, and I think the recovery process will be much quicker.
Great. Well, thank you. Does anyone have any questions? For foreign investors, any EB-5 funding or foreign investors buying your property?
Well, foreign investors, they typically invest with some sort of local manager, so an AEW, a GLP, a group like that. But a group like GLL, which is a German group that's been active in the industrial market, that are representing themselves. Audie's out in the market representing themselves right now. So, it's just tracking who are the real players and who's out there actively looking. So they come in all shapes and sizes.
Yeah.
Yes, Bob.
Competitive, they're not going to be able to, say, be in Uptown versus Park Central and still be competitive with their colleagues. That being said, I think the dynamics in Dallas have changed quite a bit with all the new corporate relocations. For example, with the Toyota North American headquarters going up to Plano, several of their ancillary companies have moved into Uptown. One of their law firm came in from California as well. They took down a full floor in one of the highest priced high-rises in Uptown. So I think you're going to see a lot of that. I don't think that that's going to dictate necessarily, and yes, we will see some recovery to some extent. But I think the demand in Dallas, we're still one of the lowest cost alternatives, speaking in terms of all other primary markets, such as San Francisco and New York and Boston and so forth and so on. So I feel strong about the fundamentals and the dynamics and the underwriting that's going into place for a lot of the new development that's going up. That's
Yeah.
Yeah, how
I
do they
mean,
get
you
those
know-
pro forma to work for the tenant?
Yeah, right, you know better than anybody, it's all about occupancy costs, and can they make those numbers work? But like what Creighton was saying, we're always tracking Dallas-Fort Worth against other primary cities. 10 years ago, we were definitely not considered a primary market. From the institutional investment side, retailers didn't consider us as a primary market, and now they're starting to. So we're seeing that shift, and I think we're starting to see numbers that reflect more of a primary market. So for retail product, if you compare to, say, New York, the top retail rental rate in New York is $3,500 a foot right now, and the top retail rental rate in LA is around $1,500 a foot right now. We have peaked at about $175 a foot in Highland Park Village. I think the Celine space was the last one, and before that was Tom Ford at $150. So we're significantly below. Now, Creighton touched on job growth. That's a huge factor, and also population growth, which obviously drives job growth. If we grow like we think we're going to grow, we're going to be on par to these major cities in a pretty quick fashion. I mean, we'll be the third or fourth one in line in the United States, but we're getting there. So, and we're seeing all of that reflected in the loss of jobs in California. So California lost 516 companies, major companies, since 2008, and we gained 43 of them. So we're picking up a huge share. That's larger than any other state. We're picking up a huge share of these relocations. So all that points to, I think, being bullish on our market. I think we're in a good spot.
Did you want to hear industrial, Bob? Well, I mean, I think on the industrial side, we've been so cheap for so long. If you look at the top 10 industrial markets, really only Atlanta is as cheap as we are. So, rent bumps and leases just became a common thing in Dallas this last cycle. So, I think our industrial market still has a good way to go. Our construction costs are going through the roof, and everybody thinks there's so much land available in Dallas, but go try and find a site north of the airport, down in GSW, even finding a good site down in South Dallas that's not already controlled for either a build-to-suit or by another developer, it's pretty tough to do right now. So we're pretty constrained in what we have going on right now and still absorbing record numbers.
Pam, I'd like to touch on the international investors question real quick. So we do quite a bit of, we entertain a lot of offers from the international side of the business, specifically this year. And one thing that we've been tracking is international capital has been coming into DFW bigger this year than it ever has. 34% of all deals that have transacted have been through international capital. The majority of that is Canada, of course, but in comparison to last year, it was 8%, and before that, it was 7%. So international capital definitely looks at the U.S., Dallas specifically, is a great place to park your money. We have that reach as experts in our specific fields, and we can tell you just firsthand that that will continue to play out, especially with EB5 having been so popular and what that has to offer to the international capital. If you're not marketing to the international buyers as well, I think you're kind of cutting yourself short, because those guys are certainly paying the premiums.
Mm-hmm. Yeah. I know on the capital gains personally, the one we sold, which I was surprised by, but you know, the 15% typical capital gains, there was an additional 8% tacked onto it to pay for Obamacare. And so, you know, where it will go will be very interesting, because that makes a decision when you're selling or not.
Well, if you think about it, it actually increases the volume and velocity for us, because people don't want to pay the taxes and they're going to trade more often than not. So, you know, you can look at the bright side of everything.
Any other questions? Yes, Leslie?
Exactly, right.
Good question, Leslie.
Great question. I'm not on the Dallas-Fort Worth Road Committee, but
You didn't
it's
take Dart here?
crowded.
Regarding infrastructure, how are all these people going to get around the city, right? I mean, with the toll and the traffic happening and 4 million new people moving here, it's a challenge. But
Yeah, it's going to get tighter on the roads for sure. The traffic patterns have changed too, if you notice. So they're reversed now on the toll road going north and south before and after work, and same thing on Central Expressway. It's an interesting phenomenon because so many people are going to work out north rather than the reverse. I think Dallas has done a very good job of trying to preempt the traffic issues by what they did on LBJ, the High Five, but we're moving at a fast clip. 4 million people in 15 years is a lot of people. So it's a great story, but, you know, leave 30 minutes early because you're going to be late.
they'll need a good architectural firm to design all those new office buildings.
And with that being said, I think the developments that offer the live, work, play type layout setup for companies as an option will continue to be more popular, and those will probably have a much more significant advantage over their competition that doesn't have that to offer. You look at Uptown, I mean, golly, you need a flyover just on McKinney Avenue.
Well, thank you so much, Dustin and Jennifer and Creighton, for being here. And thank you for all of you being here. Have a great day. Thank you very much. Meeting adjourned.
What did you say? You didn't take Dart coming
You
here?
didn't take Dart here? Yeah. They didn't put it at the Dallas,